everyone. Thanks for making it this far in the live stream. I am super excited to bring one of the premier sessions we have planned for you guys. I am sitting here with the great Pierre Rochard and the fantastic Eric Wall. How are you two doing?
Doing very well. Thanks for having us on.
Yeah, thanks for having us.
So Eric and Pierre have agreed to come here to argue for and against the stock to flow model. Pierre is taking the position of for, Eric is taking the position of against. We're going to start off with an opening statement from Pierre, then Eric, and then move to a back and forth debate. So without further ado, let's just get right into it. Pierre, why don't you introduce yourself and your position?
Yeah, sure. Pierre Rochard. I am the lead Bitcoin strategist at Kraken, one of the world's largest Bitcoin exchanges. And my position on this topic, just zooming out, I think that what I would defend is the stock to flow concept. And then there are a myriad number of models. So I would also defend people using the stock to flow variable in models, and I would defend the use of almost any variable in models for that matter. And I find the bias against using stock to flow to be interesting. Now, conceptually, stock to flow is a measure of scarcity. And even already here, there's a debate about whether Bitcoin has a stock to flow ratio, in the sense that arguably all of the Bitcoin already exist, and that there's only ever going to be 21 million Bitcoin, and that because the distribution process is known ahead of time, that there isn't really a flow. There's just there's some kind of just dilutive process there, and we already know that Bitcoin has like an infinite stock to flow ratio, in the sense that that there's a fixed cap on it. So we can argue about that. I think that that misses the fact that there are actual money flows, right? In the sense of resources coming in and out of the system, and the creation of new Bitcoin is important, because you're actually creating underlying units and making them available for distribution on the market. And so I don't buy the you could almost analogize it to, in mainstream monetary economics, this concept of rational expectations, which is that if everyone has the same expectations about any phenomenon, could be inflation, whatever, then it's just not relevant when those expectations get fulfilled. And I disagree with that school of thought. I think that even if you're fully expecting an event to happen, it actually happening is indeed new information, even if your confidence was 100% going into it. And I think that we see that in human behavior around Bitcoin's issuance as well. So I don't buy kind of the efficiency or rationality argument against using stock to flow, just because it's a function that's predefined based on, the passage of time, or the creation of blocks in the Bitcoin system. So yeah, I'll just leave it at that, and we can take it from there.
Fantastic, thank you for that, Pierre. Okay, Eric, why don't we start with your opening statement?
Right. So my name is Eric Wall. I'm the Chief Investment Officer of a Scandinavian cryptocurrency investment firm. And I would like to say that, just starting off, that I think that the halving has become sort of a religious holiday in a certain way for us Bitcoiners. I mean, I think it's a fantastic way. It happens once every 4 years. It's something that brings a lot of excitement. And I remember the last halving, I was putting the block explorers on display for my in real life friends, explaining to them this event. And I think it's generally something that we can all get together and celebrate. I think a lot of us in this industry has a lot to be very grateful when it comes to Bitcoin. I think that Pierre and myself both share that we are extremely grateful that we have Bitcoin now. It's a great monetary phenomenon. It's really something that is great for our personal lives. I'm so happy that I get to be here and I can work with Bitcoin full time. It's my passion. It's what I devote myself to 100%. I just think that when we are celebrating such an event as the Halving, it's important to set sort of the expectations right. I think that if you tell new people coming into Bitcoin that, well, the halving, it's going to decrease the ratio in which Bitcoin gets released into the system. And that obviously has some sort of positive effect on the price. I mean, supply and demand, if supply is lower, then the price goes up. But I think it's kind of ridiculous to assume that the main driver of price development in Bitcoin comes from this internal ingredient in the protocol. It's something that's been programmed so that we can say that, it doesn't really matter it doesn't really matter if we get institutional adoption. It doesn't really matter if we get more people excited about Bitcoin. The only thing that really matters to the price, and we can observe this statistically, is that there's a decrease in the inflation, the monetary inflation rate in Bitcoin. And I mean, Pierre, you have been around as long as I have, and you must realize that Bitcoin has grown as a phenomenon in the world tremendously. I mean, I remember when Bitcoin hit $1, and I remember how few of us it was that was around at the time. And since then, Bitcoin has been exploding, and people has really understand that, yes, we can have a digital type of asset that has a fixed amount of supply, and that's awesome. And we can transfer it and we can move around value. I think we had the largest transaction in Bitcoin in history just a couple of days ago. I think it was Bitfinex that had a transfer that was over $1 billion for just 70 cents was the transaction fee. I mean, I think that it's those things, the idea that we can build a new monetary system, and we're waking people up to the idea that we can create digital scarcity, and we can have a finite supply of an asset that we can transfer around. And getting people attracted to that concept is what has led to hundreds and thousands, millions of people getting attracted to Bitcoin and choosing to allocate their capital to Bitcoin. So that's what we're seeing now. We have millions of people around the globe that are getting more and more attracted to Bitcoin. And I don't think that it really would have mattered if the inflation rate in Bitcoin was 2% or 2.5% or 1.5% or 1%. I mean, those obviously, I mean, it is one of the parameters, but the main driver of the price is how much capital do people want to allocate to Bitcoin? Is Bitcoin growing as a phenomenon? Are people getting more skeptical about the concept? I mean, those are the drivers of the price. And I think that everybody who's in Bitcoin knows that. I mean, we know when the price is going up. It is when people are signing up to the exchanges, buying Bitcoin. And I've never in my life heard a person say, I was skeptical at Bitcoin when the inflation rate was 3.6%, but at 1.8%, I'm going to allocate 10 times as much capital to this asset because that's the one thing that I care about. I think that the final scarcity, that we can have digital scarcity that has a fixed cap, that's what attracts people. And I've never heard anybody, and of all the people that I've ever discussed Bitcoin with, focusing on this one single special parameter. So I'm just curious that how you could even imagine that a small fluctuation in the supply rate of Bitcoin would actually determine the price in the future and drive the price from $10,000 to $100,000. So just conceptually, I don't see that the theory behind it makes sense. So I just like to hear, how does the rationale behind the stock-to-flow model on a theoretical level even play out?
Yeah, absolutely. So I think that what's missing in your framework for this is having a distinction between risk and uncertainty. And risk is something that you can insure against. Uncertainty is something that you can't insure against. And when you think about all of the properties of Bitcoin, permissionless, censorship resistant, seizure resistant, and the monetary policy, and how those properties are, let's say, enforced, right, with the decentralization, being able to run your own node, being able to hold your own keys. What the Bitcoin system does is try to minimize uncertainty from an endogenous perspective of its properties. And we could criticize whether it goes overboard in kind of maximizing that lack of uncertainty. And that's, I think, been a criticism on the scaling side, on the privacy side, that Bitcoin is like over optimized for certainty. And so when you have a system with these properties where the uncertainty factor has been minimized, I do think that it makes sense that then on the demand side actually has a certain let's say constancy to it. That while you may believe that the demand side is very flighty, and that people suddenly change their subjective preferences with regards to Bitcoin, and thus the price could oscillate kind of over any natural number range, and that there is no anchoring of demand. I disagree fundamentally with that. I think that demand actually has a very strong anchor in the fundamentals of the system, which are tuned to be the least uncertain in the world if you compare monetary systems or transactional ledger systems. And that thus, if you have constancy on the demand side, then it would make sense to me that while demand may oscillate around a model's forecast, right, in this case stock to flow, that you would actually see it essentially mean revert when price has gone far above the model forecast and it comes back. It's because you're layering on top of the fundamentals, human psychology, right, and the animal spirits, and the bull and bear cycle. And so I think that if you combine a very stable bedrock layer of fundamentals and layer on top of that human psychology, that what you have is okay. So now we can talk about why pick out stock to flow, right? And I think that this conceptually is a kind of a debate, less on the model and more on less on Plan B's model and more on Saifedean's analysis in the Bitcoin standard. And in conversations about supply, I think that the first thing to establish is that demand is basically infinite, right? And so people want to own as much Bitcoin as they possibly can. And now, we can talk about portfolio allocation and, do people know about Bitcoin's uncertainty or its relative lack of it? And then the education process and all of that. But I think that the reason why, rather than trying to analyze Bitcoin from an epidemiological, I'm going to try to use that word, been trying it now with coronavirus, but where basically the knowledge about Bitcoin is spreading like a virus, right? And so then we would expect the price to be following that rather than the price to be following a certain stock to flow ratio. I think it has to do with the issuance and the burning of electricity. All right, what's behind stock to flow? It's consumption of real resources in the real world. That is actually suppressing the price because you are putting supply onto the market, and that if you stop suppressing the price, then it's going to go up. Now, there's a tension there where, like, okay, we're also trying to get this asset out in the world. So, if we have an asset that has an issuance of 0, which is like, okay, all the 21 million Bitcoin already exist, or 0 Bitcoin exist, or anything in between. Like, that to me is like, all right, this model is going to break, right? And I think we should talk about that too. Just like Moore's law, broke as well for semiconductors. And so I think that once Bitcoins have all, materially been mined, which is much sooner than when they all have been mined, then Bitcoin's stock to flow, modeling will pretty much be obsolete. But anyway, I've rambled on, so I'll let you respond.
Yeah, the one thing that you said that I take most issue with here is that you seem to rely on a notion that demand is somehow supposed to be constant through all of this. I mean, the demand for Bitcoin, that's a human element that could have developed in either. I mean, we could have seen marginal, tiny amount only people, buying Bitcoin for darknet purposes, or we could have seen a narrative such as the digital gold narrative take hold and grow and propagate through society. I mean, that's a highly volatile thing, and there's no way that we can predict whether or not these narratives are going to take hold in the market and how large that demand is going to be. But you're talking about it as if we're going to have the demand for Bitcoin, and it's going to grow as this exponential phenomenon, and then it's the stock to flow that's going to determine exactly how large those bubbles get. But I would say that rolling back the tape 5 years from now, it's a human phenomenon, and it could have gone either way. It could have gone to just 1%. The interest in Bitcoin could have been just 1% of what it is today, or it could have been 100 times higher. And it's followed a particular trajectory right now. And when you're relying on the stock to flow model, you are essentially saying that the final price that is being set, it didn't have to do with whether or not these narratives developed successfully in society. It only had to do with that there was some type of demand, and then the stock to flow sorted out the rest. So I don't understand this consistency of demand argument that you're making at all. It could have been at extremely different levels. So that's a very, very strange argument to make, in my opinion. And I think that we should probably also discuss, because it's not only a theory. It's not only a theory that you have that the stock to flow model is based on, and it's not that theory that is actually attracting people into believing in the stock to flow model. It's also the statistics. And you, Pierre, you've been one of the most valiant proponents of actually looking at the R-squared values and looking at the co-integration tests. That was it was those tests in the quantitative analysis that was the thing that made people looking at the stock to flow model as something that cannot be denied, and it's more than just a theory. So I think we should probably dive more into that. And as you probably know, during the last couple of weeks or days or so, much of the quantitative model, and I for a long time criticized that these quantitative models that are being used are not robust, and the co-integration analysis that people have been relying on are not fully understood, and people are using this to blow the model up into something that is much more than what it is in reality. So I think that I'd like to hear also your view on how much do you rely today on the statistical support for the stock to flow model, because I think that's the thing that's breaking down right now. And if you don't have that, then you only have this hand wavy, wishy-washy. I think that when the inflation rate goes down, the price goes up, but there's no support for that. I don't think that the case that you've made for the demand side being consistent has support. And I don't think that we have even support in the statistics side of the stock to flow model anymore. So we can discuss R-squared, co-integration. I mean, just give me your best position there.
So on the demand side, I think that what you're missing is that the fundamentals have not changed. And so Bitcoin's fundamentals of trustless, permissionless, seizure resistant, censorship resistant, and then its monetary policy, those have been constants. And so then everything that you're talking about in terms of memes and narratives and darknet markets, et cetera, all of those are downstream of the fundamentals. And so If they ultimately are not supported by the fundamentals, then they get crippled and annihilated, right? If they are supported by the fundamentals, then they can grow and amplify. And so I think that on the demand side, the reason why you have this base amount of constancy is because of Bitcoin's fundamentals. And then you layer on top of that, yes, there's psychology of, you know, people getting into the HODL meme or Bitcoin gold or, you know, digital gold or whatever. Like, but those are downstream from the fundamentals, and they would not exist if it was not for the fundamentals, right? Like, if hodling actually had negative results in the sense that your purchasing power would have decreased over the past decade, then that wouldn't be a meme. No one would be like promoting it as something that's a good idea. The reason it became and stays a meme is because it resonates as true because of people's experiences with Bitcoin, and because they have experienced these properties that we are, you know, so strongly championing every day.
No, I have to interrupt you there, because fundamentals, yes, they are constant. That's one thing. But the thing that drives the price are people's appreciation and understanding of the fundamentals. How well are Bitcoin's fundamentals understood, and how much are they being valued in society? There is no fixed formula for how quickly people are going to understand that the fundamentals of Bitcoin are good and reliable, and the people want to allocate capital to that, especially not when we're dealing with such a new and arcane and strange phenomenon as Bitcoin. That's an extremely complicated and multi-varied thing that reflects on how, in us as humans, how we appreciate those fundamentals. And you cannot say, well, we had the fundamentals and we were just, because of the fundamentals, the demand was just going to go according to this prefixed plan. I mean, it's still, I mean, you have some fundamentals, you roll the dice and you throw this phenomenon into a human society, and how the price develops completely is the description of the appreciation of those fundamentals, not the fundamentals themselves. And that's why I'm saying you cannot predictably model that the demand for Bitcoin would have been constant or nearly at the level that it is today. So yeah, but maybe we could leave that aside and go back to what are the statistics, what are the statistical support for this model? Because you have been on Twitter and towards me and many other stock to flow critics have been rebutting our retorts by saying there is statistical evidence for this model that cannot be rebuked. So how do you view the statistics of the stock to flow model and the R squared and the co-integration today? Have you changed your perspective on that? Because I would like to see perhaps a little more humility in that sense, that we have some statistics, we have been able to make OLS regressions on this data, but I don't think that there's any evidence that we have been able to identify a spurious relationship from a non-spurious relationship, at least if you ask the most up-to-date quants on the stock-to-flow model right now.
Yeah, absolutely. So now on the demand side, you said that the appreciation of the fundamentals is what matters. I think that takes kind of a very idealistic view of markets, in the sense of you're essentially ignoring Adam Smith's invisible hand and asserting that the hand has to be very visible in order for market participants to be pricing this correctly. And I think that's just wrong. I think that you can have people using Bitcoin without actually understanding its fundamentals or being able to verbalize them or consciously aware of them, and still yet have the same economic phenomenon go on. And so if you drop a technology like Bitcoin into society, I do think that there's a certain like diffusion equation, right, of people learning even like what a Bitcoin address is and like how to actually interact with the system. But that process is actually mediated also through the price. Like, we know how many people see the price going up and decide to jump in because of that. And I think that in terms of like different assets are going to be susceptible to reflexivity at different rates, right? And so, you know, a consumption asset, not so much. A monetary asset, it's the only thing it's got is that Keynesian beauty contest of other people using it. So if we take that as kind of the second layer, right, on top of Bitcoin's fundamentals is the social Keynesian beauty contest part of it, that's where I think that you get into, okay, here's why, you know, here's why there was two bubbles in 2013 and why it oscillated around its, let's call it, you know, fundamental value. And that it's not like people receive Bitcoin, don't understand its properties, and thus that like causes the price to crash. Like that's not what actually moves the price of people. Like, oh, people understood Bitcoin better in December of 2017, and then they like forgot about the fundamentals for 2 years, and so we had a bear market. Like I don't buy that argument at all. I think that there's a lot more going on there.
I have an extremely simple question for you then, Pierre. So,
hey, so
you know,
really quick, Eric, I don't mean to interrupt. We do need to get to last word. So maybe you can pose your question as part of your last word, but why don't you use this time to wrap up and pose a question to Pierre, and then Pierre can close it out.
Okay, well, my stance is that the underlying theory behind the stock-to-flow model is weak. I don't think that the statistical models have been successful at identifying a spurious from a non-spurious relationship. And I think that much of the hype around the stock-to-flow model was that we had the co-integration tests that have now been proven to not, well, the quants that did the analysis have now rebuked from that and have said that, well, we did the co-integration tests incorrectly, and it's nothing. Even Marcel Berger says that, you know, when you have two trending variables, it's not that strange to find an R squared variable that is very high. So there is actually nothing that is in support here that the stock-to-flow model actually has any statistic background in being predictive in any sense of the word. And so my last question to Pierre would be, so right now in Bitcoin, the miners in Bitcoin, they could choose to burn a part of the block reward. And if they just choose to, after the halving, they choose to burn 50% of that, that would bring us to a stock-to-flow that would be the stock-to-flow that we would have after 2024. So we would jump, according to the stock-to-flow model, if miners just choose to decrease if they just choose to burn 50% of the supply, that would bring us, according to the stock-to-flow logic, immediately to $1 million per Bitcoin if they just choose to do that. Meanwhile, they're still getting more reward. They're still getting paid more in dollar terms because the Bitcoins that are left are now worth 1 million each. So 3 Bitcoin, that would be 3 million per block that they would earn if they would just choose to burn 50% of the block rewards. So why don't we just do that? Why don't we just skip to the next halving basically by using a soft fork in the Bitcoin system? Because that's what the stock-to-flow model proposes.
Yeah, I think that changing Bitcoin's reward schedule is kind of a third rail in Bitcoin politics that you don't want to touch.
It's not changing it. The monetary policy only says that miners have the ability to extract, 12.5 or 6.25, but they can choose according to the monetary policy that we always agree on.
So
not all of that. So
this is where like your lack of understanding of the Bitcoin system really shows, because the problem that a miner would have doing this would be to get other miners to cooperate with them and to actually like go with the soft fork.
But it's the positive shelling point. It would benefit all of them. You only need 5 or 6 miners to agree to this, and they would know that we would get.
So it's important to understand the difference between miners and mining pools. So while you might look at a graph and you might think, oh, like this mining pool controls 40% of the hash.
I agree with that. But do you believe that if they did that, because this is interesting to me, do you believe that if they did that, if they chose to burn 50% of the block reward, that we would see a 10 times increase in price if they just choose to do that?
No. And why would that happen?
because then the stock to flow would, according to the stock to flow model, then the price of Bitcoin should be 1 million per Bitcoin if you just run the stock to flow maths.
Yeah, so I think this is where people focus on the math too much and don't focus on the fundamentals enough. Like the fundamental table stakes is that Bitcoin is the system with the least uncertainty possible, right? And so once you start getting into soft forking economic properties of the system, you're now dialing up the uncertainty in the system. And so I would expect that the price would crash, right? That people would be like, hey, what's going on? That there's a mining cartel.
Exactly. And this is my point.
Rules are being manipulated like this.
Yes, and this is my point. It's not the stock to flow that matters. It's the appreciation of the fundamentals of the system that actually matters. It's not that we have the stock to flow that is at an exact variable. It's the whole Bitcoin system and the appreciation of the fundamentals that drive the demand for the currency, not the specific S2F variable that we have right now. So I think that kind of concludes.
Hey,
yeah,
really quick. I think there's been a fantastic discussion. Let's allow Pierre to give his final word, maybe respond to that question or that take, and then final word, and then let's close it out.
Yeah, I think that the fundamentals are ultimately what drives the value of Bitcoin. And one of the fundamentals is the monetary policy and the stock to flow and the lack of uncertainty around it. And then seeing that lack of uncertainty, validated with each block, and then through the halvings. So that's where I think that there's overlap. Now, on the statistics side, I don't know. I'm not a quant. I just look at what people are saying and parrot what they're saying. So when people, when the quants find something, I'm happy to promote it. When they find that they were wrong, I'm happy to promote that as well. I find it odd that we don't want to actually refute the quants on their level, and instead there's kind of the quants have to refute themselves, right? And so like it wasn't Eric that actually did the work to figure out the co-integration problems. It was the people who were initially promoting co-integration and discovering it, that they were the ones who found the problem. So
I
think
skeptical of it, and you were parroting it basically. Yeah, that's also kind of what happened.
Yeah, so if you have a bias in either direction, so my bias has always been for stock to flow, right? And this goes back to my interest in Austrian economics. And your bias, I guess, was against it. And that's fine to have a bias, but ultimately, like the work has to happen in order to refute the other side. And that's kind of how it moves forward, is through falsification.
All right. Well, it's been a great discussion. I'm happy that we're here for the Halving. I think it's a great celebration for all of us, and it's okay to have different ideas, but I've made my points, you made yours. Let's just agree to celebrate, at least in the light of all of this. Cheers.
Happy having, folks.
Happy having.